Please subscribe to the channel. If you press the bell icon, you'll be notified of Kalkine's latest videos. Today's trending topic is 4 key reasons why a stock is undervalued. Want to know why a stock is undervalued? Stay watching this video. I'm Sage for Kalkine Media. We've gathered 4 crucial points to highlight why a stock is undervalued. And undervalued shares are referred to as those stocks that are traded at a lower market value than their intrinsic value. And the phenomenon is directly opposite to what happens in case of overvalued shares. Overvaluation of a stock occurs when its market value is higher than its intrinsic value, and the intrinsic value of a share depends on the company's fundamentals, and this value can be evaluated using financial statements, cash flow, profits, management of capital, and returns on assets. And generally, investors employ value investing to determine if a stock is undervalued or overvalued, and traders purchase undervalued shares at low prices with the belief that the accurate worth of the stock would be realised going forward. And there are several reasons for a stock being undervalued, and here we will discuss the 4 factors that determine the undervaluation of shares. Weak stock market conditions. A weak market scenario is generally considered as the foremost reason to explain the undervaluation of shares, and there are times when the overall market sees a crash due to reasons including herd mentality and overinvestment, rendering several stocks undervalued, and thus investors should be aware of ongoing market conditions to determine the share valuation. Cyclical behaviour. Cyclical behaviour also plays a key role. The seasonal nature of a business or the company's production and sales also define the profits garnered by it, and a low demand for the company's products or services can reflect in the form of weakness of its shares. And even if a company boasts strong fundamentals, the stock price is bound to get undervalued during a decline in its sales. However, a stock market works in a cyclical manner, and the undervalued stocks with strong fundamentals generally rise again when the company's profits rise. PE ratio, or price to earnings ratio. The PE ratio tells how investors think the company is performing or how much they are willing to pay for $1 of earnings, and generally a stock with a PE ratio below the industry average is considered undervalued. Low PE generally translates more profits against the price paid for the share. Value investors closely look at firms with low PE ratios to maximise their profits. P/B ratio. The P/B ratio is the ratio between the firm's book value and the price per share. It reflects the company's financial strength. Low market value compared to the book value is the mark of the best undervalued stocks. And if you do like this information, please like, share, comment on the video below. We'd love to hear your thoughts. Subscribe to the channel and press the bell icon. You'll be notified of Kalkine's latest videos. For more information and regular updates, we do have a website. It's kalkinemedia.com. Please check it out. And my name's Sage for Kalkine Media.